Hey everybody, welcome to your weekend review for the week of Monday, February 13th, 2023. And oh, what a week it was. Monday started off being down 5 basis points in the morning. Treasuries were mostly sideways in the overnight session, which isn't too surprising given last week's big sell-off and looming CPI data coming on Tuesday. The week ahead, we'll have some important data on housing and inflation with the CPI on Tuesday and the producer price index on Thursday. We'll also get housing starts and builder sentiment. Other important data points are retail sales, small business optimism, and leading economic indicators. Loan demand has been falling while lending standards are getting tighter according to the Fed. This is typical for an economy that is poised to enter a recession. Loan demand for residential real estate was weak and standards tightened on HELOCs, credit cards, auto loans, and other consumer debt. The Fed also observed the same phenomenon for commercial and industrial loans as well as commercial real estate, which is actually what they want. They want companies to not be able to borrow money so that it cools down our economy. The Atlanta Fed GDP Now Index sees 2.1% GDP growth in Q1 of 2024, while the street sees it as coming in mildly negative. Reprice risk on the day is moderate. There isn't any data to worry about, but we could see moves ahead of the CPI data. Remember that tomorrow's data could push rates either way. It won't drive us back to new lows we hit earlier this month. The CPI data comes out on Tuesday at 8:30 a.m. Eastern time, so it'll affect the rate sheets before most people even come in. At the end of the day on Monday, we opened up at 100.234. Ended up at 100.482, so a pretty mild day, not a lot of volatility on the market. But there was volatility in the mortgage business. Jay Farner is leaving Rocket Companies as the CEO, so he is ending his 27-year tenure with the firm, ending as a CEO. He's stepping down as the member of the board of directors last week. Bill Emerson will be taking over for Farner, who has also been with the company for about 30 years. Mr. Cooper is buying Roosevelt Management Company in a deal that will bring them an asset management company platform that will allow them to raise capital from institutional investors. Speaking of Mr. Cooper, they also see $1.5 trillion in MSR opportunity in 2023. They continue to be strategic in their acquisitions of MSR assets and a strong capital base. They can take advantage of opportunities created when others are needing to sell. Got a post from our sponsor at WellThatMakesSense.com. So this was from Jocko Willink. It was summarizing a quote from Bill Shakespeare's Julius Caesar, where he said, "Between the acting of a dreadful thing and its first motion, all the interim is like a phantasma or a hideous dream." Well, let's take a look at what that means in real life. So, between the acting of a dreadful thing, so in between the moment when you are waiting to do something that you don't want to do, and the first motion, which is the moment in which you initiate action, all of the interim, so basically the whole time between you realizing you have to do this thing that you don't want to do and actually doing it, is like a phantasma or a hideous dream. It's like an evil specter, an apparition, or a nightmare. So eliminate that gap. Hesitation turns into cowardice. To win, all you have to do is overcome that moment, the waiting, the hesitation. And to do that, all you need to do is go. So go forward and win. So it's basically talking about, and I think this is a great application to when it comes to cold calling. Nobody has a lot of fun doing cold calls, but the big trick is to just pick up the phone and do it and stop thinking about it. Tuesday was the day we were all waiting for, February 14th, which is CPI day. UMBS were down 9 basis points net on the open. 10-year yields were slightly lower on the day and initially reversed higher due to the modest upward revision to last month's core. So with CPI numbers being as mixed as they were and the sheer volume of trading waiting on its report, it's no surprise to see two-way volatility as the morning progresses. And now that it's back into the red early on, like I said, down 9 basis points. The month-over-month core CPI came in at 0.4 and a 0.4 forecast. Is 0.4 previously. The market wanted to see that go down. Year-over-year core CPI came in at 5.6 on a 5.5 forecast, so hotter than expected, but still lower than the 5.7% last month. So the consumer price index rose 0.5% month over month in January, breaking the streak of lower monthly numbers. Excluding food and energy, CPI rose 0.4%. Inflation rose 6.4% on an annual basis. Shelter is the biggest addition to the inflation, and that will fade over time. Federal officials said interest rates may need to move to a higher level than anticipated to ensure inflation continues to fall after fresh data showed. Richmond Fed President Thomas Barkin, speaking on Bloomberg TV on Tuesday, said that if inflation persists at levels well above our target, 6.4% is well above their target, maybe we'll have to do more. Then the Dallas Fed President came in and said we must remain prepared to continue rate increases for a longer period than previously anticipated if such a path is necessary to respond to changes in the economic outlook or to offset any undesired easing of conditions. So basically, the Fed is saying over and over again they are going to keep hiking rates until the inflation is down. They don't care. And as long as jobs stay low, as long as jobs stay full, they're going to keep hiking rates, and the market just needs to accept that. It'll take one of two things for the current rising rate trend to run its course. Either the economic data needs to shift in a compelling way, or the selling needs to take rates back to 2022's highest rates, at which point the market will conclude a compelling economic shift is imminent. Neither option is fun for the mortgage housing market. Today's CPI wasn't as much of a barn burner as the job report 2 weeks ago, but it was high enough to prove the Fed's persistent point regarding stubbornly elevated inflation. Then today we were down 25 basis points at that 100.24, which that's right above that Fibonacci line, or right below the Fibonacci line right there, and it's below the 100-day moving average. So we moved into a very low range with 100.014 as a floor. We also got news that Black Knight is close to selling its Empower LOS in order to gain antitrust approval to merge with Intercontinental Exchange. The antitrust regulators were almost certain to prohibit Encompass and Empower from being under the same roof. Encompass and Empower are the number one and number two loan operating systems, in which it's pretty much a concentrated industry. No mention of who would be the buyer. Also good to keep in mind that same company owns Optimal Blue that probably does a lot of your pricing. We also got a post from our sponsor at WellThatMakesSense, which is the 5th post in our copy about how to write sales copy. So you need to create a slippery slide that will cause people to traffic to your ad through the entire text and on to buying. So read our post at WellThatMakesSense.com to find out how to do that. Another day of MBS being down on the open. Today we're down 11 basis points early. Both of this morning's reports were obviously much stronger than expected, but it's retail sales that carries the biggest stick. That stick is currently pointed directly at bond traders in the direction of the sell button. After the flat overnight session, 10-year yields were up a quick 3.5 basis points at 3.788 in the morning. Retail sales came in at up 3% when it was supposed to be on the forecast at negative 1.9. It was negative 1.1 previously. So people just keep spending money, which is going to keep increasing inflation. The New York Fed Manufacturing Index came in at minus 5.8 on a negative 18 forecast. It was negative 32.9 previously. Yet more good news, which hurts the bond market. U.S. retail sales rose in January by the most in nearly 2 years, signaling a robust consumer demand that could bolster the Federal Reserve's resolve to keep raising interest rates. Whilst when stripping out autos and gas, it's still up 2.4% after a negative November and December. This is especially strong. Mortgage rates are rising now in anticipation of future Fed action. Markets are pricing in 3 more Fed rate hikes, with a Fed rate above 5.25 heading into 2024, when just a couple of weeks ago at their recent lowest, and markets was pricing in 1 more hike, and actually a lot of people were anticipating a cut in 2023. Home builder confidence improved in February. Oh, Jesus, for the love of God, thank God these people are finally looking up a little bit. With the largest monthly increase in builder sentiment since June of 2013, the HMI indicates that the incremental gains in housing affordability have the ability to price in buyers to the market. Man, that is it hasn't changed that much, and it swings sentiment that much. I hate that measure. I think I only report on it so I can bitch about it at this point. Cass Freight Index measures shipments and the cost of shipping goods. If shipment component was down 3.2%. If the slowdown continues, it's recessionary. The 20-year auction this afternoon gave an indication of where we are really. The 20-year auction was met with average demand. The cover was 2.54, which was below the 1-year average of 2.59. Direct and indirect bidders took 93.3% of the bids versus an 88.3% average. We also got industrial production, which was flat in January, according to the Federal Reserve. Manufacturing output rose 1%. Capacity utilization fell 78.3%. Ooh, that's not very efficient. At the end of the day, we were down 5 basis points, ending us over at 100.19. At 100.19, that's putting us right above this blue line, which is the S1 Fibonacci at 100.094. All these ranges are kind of converging on each other, but we're getting a lot of volatility because people are trying to predict the market and all the data coming out. And on Thursday, we had another tough open for bonds. They were down almost a quarter point really early. Treasuries were up 4 basis points. Bonds were sideways in quiet overnight trading. The big jump in producer prices and a sub 200,000 print in the jobless claims kicked off a lot of the weakness around 8:30. And then Lorena Meester introduced the idea of a 50 basis point rate hike that got things moving even more quickly 15 minutes later. This view was later echoed by her counterpart at St. Louis, being James Bullard. Jobless claims came in at 194,000 on a 200,000 forecast. It was 195,000 last time, down 1,000 on the week. Continuing claims rose 16,000 to 1.7 million. Core producer prices month over month came in at plus 0.5 on a 0.3 forecast. Headline PPI came in at 0.7 on a 0.4 estimate. December was revised up from 0.5 negative to 0.2 negative. Inflation at the wholesale level grew at the fastest pace since June of 2022, according to the Producer Price Index. This is after 2 months of declines in November and December. The index rose 6% on an annual basis. Energy costs were a big driver. That was higher than street expectations as well. Then we got the Philly Fed, which came in at negative 24.3 on a negative 7.4 forecast. It was negative 8.9 previously. Housing starts came in at a 1.309 million annual pace on a 1.360 million forecast. It was 1.371 million previously. As I said, Lorena Meester was quoted as saying he saw a compelling case for 50 basis point hike at the last FOMC meeting. We also got news that investors bought 48,455 homes in the fourth quarter of 2022, which is the second biggest quarterly decline on record. An AHB home builder survey for February increased 7 points. About time they have something optimistic to say. From 35 up to 42 is the strongest 1 month gain in 10 years. Present conditions increased by 6. Future outlook by 11 and traffic by 6. Okay, let's be real. The conditions have not changed that much in the last month. For them to change their sentiment that much over this slight change in our lending environment, these home builders, they need some mental readjustment, if you ask me. But at the end of the day, we are down 11 basis points on the day, basically right at a par on the UMBS 5.5. Puts us right underneath this 100-day moving average at 100.292. We have a floor at 100.054, which it blew through as well. We have a floor at 100.094, which we blew through as well. So the next floor is at 99.845, which actually got tested yesterday. So we'll have to see where the market determined that we are ending up. If you want a deeper dive, Chris Whalen has a great editorial about how the FHFA is changing the rules for servicers. This is all a result of COVID. Essentially, loans and forbearance during COVID won't be offered the same sorts of reps and warrants relief as typically granted during a natural disaster. So the reps and warrants pertains to the things that can be pushed back on the lender in terms of losses. This creates an open-ended liability stream for mortgage bankers. Essentially, the government asks servicers to offer forbearance and can now slug them out over it. So they said, hey, we have to offer these forbearances. And they're saying, well, but you also have to eat the negative effect of that. He also mentions that a lot of banks are sitting on a big unrealized losses on their portfolio of mortgages originated in 2020 and 2021. This includes Fannie Mae and Freddie Mac, which might explain the change in policy. He stated the banks have a $350 billion deficit available for sale securities and loans. Many of these securities and loans are now trading at a 15 to 20 point discount in the market and might have to be sold at some point fairly soon. Funds which are flush with cash might be able to pick them up as a good trade if that happens, but it'll be at this massive discount, which will hit these mortgage bankers and cause them to increase their rates. We also got a post from our sponsor at WellThatMakesSense.com. It's the 6th edition of Learning to Write Sales Copy. So this is about the emotion principle. Every word has an emotion associated with it and tells a story. Every good ad is an emotional outpouring of words, feelings, and impressions. So every time you write something, make sure you have an outpouring of words, feelings, and impressions. Check out how on our sponsor at WellThatMakesSense.com. And then on Friday, we got another one, just like the other ones. One more time. MBS were down 16 basis points on the open again. Slightly weaker out the gate in Asia with additional weakness in Europe, but some resilience heading into the domestic hours. U.S. equity futures and European stocks dropped in the face of hawkish comments from Federal Reserve and European Central Bank officials that ramped up investors' expectations of higher interest rates. Welcome to the program, fellas. The dollar rallied and bonds fell. Federal Reserve Bank of Cleveland President Loretta Meester said that she had seen compelling economic case for rolling out another 50 basis point hike, and the St. Louis Fed President James Bullard said he would not rule out supporting a half percentage point increase at the March meeting. ECB Executive Board member Isabella Schnabel warned that markets risked underestimating inflation. I'd say go ahead and do it. Let's just do the 50 basis points. We know we're going to do it anyway, so might as well pull off the Band-Aid and see what happens. Good morning. MBS were down. We're below 100 on the 5.5 ceiling of the Fibonacci at 100.094. March Fed futures are now factoring in a 21% chance of a 50 basis point hike at the March meeting, and the 10-year yield has moved up dramatically in the past 2 weeks. The index of leading economic indicators declined again in January, according to the conference board. Among the leading indicators, deteriorating manufacturing new orders, consumers' expectations of business conditions, and credit conditions more than offset strength in the labor market and stock prices to drive the index lower for the month. The contribution of the yield spread component of the LEI also turned negative in the last 2 months, which is often a sign of a recession to come. While the LEI continues to signal recession in the near term, indications related to the labor market, including employment and personal income, remain robust so far. Let's just go ahead and, the sooner we go into a recession, the sooner we come out of a recession. So I vote, let's just get it over with. But then again, I'm an accelerationist. So at the end of the day, we ended up being up 16 basis points, so quite a rally in the afternoon at 100.23. So at 100.23, we're just above that red Fibonacci line right there at 100.094. We have a real tight convergence of very many ranges. So we have a ceiling at 100.294, and then another ceiling up a little bit higher than that, right around 100.758. So a lot of different supports and things like that going on there. If you think you got problems, lender and vendors aren't the only ones who have had a bad 2022. Redfin, the owner of Bay Equity Home Loans, as well as a large player in the real estate world, lost $320 million last year. This is after a $57 million gain from buying back senior notes. So some would say Redfin really lost $377 million last year. Ouch. Market is closed on Monday, so everybody gets to chill out for a little bit. On Tuesday, we get existing home sales. Feels like we just got that. And then a 2-year note auction. On Wednesday, we have a 2-year and a 5-year note auction, as well as the refi index. Thursday, we get normal jobless claims and continuing claims, as well as a GDP prelim and a 7-year note auction. And then on Friday is consumer sentiment. So we got a lot of auctions and consumer sentiment coming up next week. So you have an extra long weekend. So check out our posts at our sponsors at WellThatMakesSense.com. Great series going on over there right now about how to write copy so that people pay attention to what you write. And then tons of knowledge available amongst these other influences. Have a great weekend, everybody. Stay safe.